All right, so let's dive into this scenario over here. So we have a scenario over here. We're just going to call this individual Mary. Mary is a single federal employee, 61 years old, still working, making $182,500. Came to us, and then we were to talk to her about her IRA. She has about an IRA that has about $943,516. So we talked to her about tax strategies and stuff. So we put Mary in a 6-year Roth conversion window that could save her almost about over $800,000 in taxes and also in armor fees, right? Okay, so we're going to talk about this. Let's look at Mary's scenario first, okay? So Mary is single, the tax filing is single. She is 61 years old now and then has an IRA balance of $943,516. Mary's pre-retirement income, the income that she's making now, her salary, is $182,500. And then Mary also told us that now when she reached age 65, she is going to join, she's going to opt into Medicare Part B, and then that would be at 65. And then we're also basically talking to Mary. Mary has beneficiaries, and then when she dies, she plans to have that money to go to them. So based on our calculation, if the money goes to them, they will probably at some point taxably increase, will have the tax increase about about 32%, okay? All right, so now that we looked at that, so let's look at Mary's information here. Like we talked about non-IRA retirement income. This is more like, income source in retirement. So obviously Mary can have like $99,791 in retirement. And then Mary basically also talked to us about, hey, she's not planning to take Social Security until age 70. And if she waits until age 70, because Social Security will increase, her Social Security amount will come down to about $46,248. Pre-retirement income, what she's making now, I already talked about that, $182,500. So Mary's projected retirement is, if you add these two together, you're talking about $146,000 in income, retirement income coming, okay? Now, what's Mary's IRA balance now? Is $943,516. And then conversion amount, the money that we're going to convert into a Roth, well, we decided that we're going to basically convert the entire amount of the IRA. We're not going to do it at the same year, but we're going to do that, spread that out within 6 years. And then we're also saying that, okay, this money is going to grow at the rate of 6%. The IRA and then the Roth IRA are going to grow at 6%. And then conversion is going to start at age 61, and then we're going to do it for 6 years up to age 67. So let's look at another scenario over here. Here we're going to talk about the taxes and then ARMA's assumptions, right? What is ARMA? It basically means that income-related monthly adjustment amount. This is the income, the surcharge that you're going to pay on your Medicare premium, because your Medicare Part B premium is based on the income that you make that year or 2 years ago, right? So if you're 65, they'll look back 2 years, that means 63. So they're going to look at it and say, how much income did you make at age 63? And that will determine how much Medicare premium is going to be for you, okay? So let's look at the effective tax rate. Mary's federal effective tax rate is 19.6%. What is an effective tax rate? Because people here, we have a tax rate and then your effective tax rate. Okay, tax rate, effective tax rate is the actual amount of tax, the percentage of tax that you pay, okay, after you do all the deductions and all that. Now, state and local taxes, Mary lives in the state of Maryland, obviously will have to pay tax on that. We assume that's going to be 7%. So if you add those two, the combined effective tax rate is about 26.6% in taxes. So you see that $943,000 over there? What's growing, what Mary doesn't understand then is 26.6% of that belongs to who? The politicians. So Mary will have to account for that. Now let's look at some of the model changes that we proposed to Mary. We're saying that, okay, tax laws are basically going to change. We happen to believe that tax laws can change, right? I mean, obviously when they passed the Tax Cuts and Jobs Act, that was going to sunset December 2025, when that actually happened. So they make the tax law kind of permanent now. But we happen to believe that on average about 8 years, tax laws will change. So we happen to believe that tax laws will change Okay, and then it'll probably change by 30% increase, and then that we're saying that that would happen 8 years from now. And then we also believe that the ARMA rate, they don't change. The ARMA increase it changes every year. So we're projecting that that's probably going to be at the rate of like 6% a year. And then their beneficiaries, Mary's beneficiaries, the kids, by the time Mary passes, and that money will go to them for them to deplete that account in 10 years, we're projecting the tax rates are going to be at 32%, okay? So that's our assumption over here. So let's look at the milestone. Well, we sit down and talk to Mary about key milestones that Mary need to think about, okay? Well, we know that Mary, well, today you are 61 years old, life is good, you're still working, you're making $182,500, okay? Well, from 61, from now, this year to 67, that's what we're trying to look at, like in a window for you to convert your money from the IRA into the Roth. This time frame over here, yeah, there's going to be a little bit kind of like uncomfortable with taxes because we're going to have to pay tax on here, okay? So we're going to convert this amount in the span of like, 6 years, okay? Now, Mary, we know that we want to retire next year at 62. Okay, so her retirement starts there. So she's going to retire at 62, and then we're projecting Mary to live up to age 100. Okay, well, another time frame that milestone is with 65. Mary, you told us that you're going to opt into Medicare Part B. Well, that starts at 65. So that means that Medicare premium can actually increase based on the income that you're making, okay? Now, we also project that in 8 years, we told you 8 years, we think the taxes might actually end up going high. We project the tax rate might go about 30%, right? Okay? And I'm not saying they'll pay 30%. If you're 24%, we're saying that the taxes might end up like increasing 30% of 24%, right? So that might put you into a higher tax bracket. So that will probably begin at age 8. And then Social Security, Mary told us, going to start at age 70. So Social Security come down to about $46,248. And then at age 73, this is when the politicians will force Mary to start taking money out of this account. It's called the required minimum distribution. She doesn't have a choice. She'll have to take that money out. If not, she's going to have to pay 25% penalty on the money that she's supposed to take out and she didn't take out, right? So that would be scary, and that would be a lot, right? We don't want that to happen. So let's look at the tax scenarios over here. So we talk to Mary and say, Mary, well, you have 3 choices over here. Option 1 would be you can keep your IRA like how it is and then don't do anything. Just keep it like how it is and don't do anything. Well, the money will grow at the rate of like 6%. But at some point at age 73, you're going to have to take money out for required minimum distribution. From 73 all the way to age 100, the total taxes that you pay on that $43,000 is what? $1,912,171. That's the total taxes you pay from 73 all to age 100. Now, because you're taking that money out from the IRA, now the required minimum distribution, remind you that money now is like $940-something thousand. By the time you get to 73, that money will now actually have grown significantly, and now your RMD becomes bigger. So that amount that you're going to take out plus your income that you're going to get from your pension, your Social Security plus your RMD amount can put you into a higher income. So therefore, the Medicare surcharges that you'll pay is about $614,000. Now, folks, if you add these two together, then that means the retirement tax bill on this account right now, lifetime, is $2.5 million. Unbelievable. Mary looks at her and be like, wow, I never thought about it. Or I say, Mary, well, you know what? That's why you're precisely here. Our job is to be able to show you that way you can make a smart decision, right? So Mary looked at it and said, well, I don't know whether I'm in the business to give that much to the politicians. And I said, well, you got that right. We agree on that, Mary. Well, and I said, Mary, your other choice is not do anything, but what you could do now is you could decide that you want to take out $63,000 every year out of this IRA account. You could do that. Well, that's probably going to be slightly better because when you do that, because you're taking money out, so that will lower your tax bracket, I mean your taxable amount, I mean your tax burden. Now, the total taxes from 73 to 100 now comes down to about $910,000. And then the RMD charges here would be about $300,000. So if you add these two together, it comes down to $1.2 million, right? That's still very significant, but is that better route than the first option? Absolutely. Given those two, yeah, definitely you will do this one. But that's when we come into play and tell Mary, we think we have a better solution. We have a better route for you. That way you can skip more of this money to yourself and your family. Let's look at that. So we talked to Mary as well. Mary, well, we know that you are in this spot now, okay? You have this $900,000 that you're looking at now. It looks great. You think it's yours, but we're going to basically put this into reality. We're going to start taking some of this money out and then be able to pay the tax on it and then be able to put the money into the Roth, because we know that when that money goes into the Roth and you meet all the qualifications, that when it grows in there, it becomes tax-free, okay? Now, but does that mean that Mary will have to pay more taxes now? Absolutely. So folks, listen, we're not giving tax advice over here. I would highly recommend that you talk to your tax professional to talk about strategies over here, because when you do the Roth conversion, it can lead into you paying higher taxes, right? What we're looking over here is to provide tax strategies over here for you, right? But in this scenario, we're able to have a frank conversation with Mary and say, Mary, hey, we're doing this, you're going to have to pay taxes now. So the taxes that you will pay now, it will cost you about $315,000, $782. Ouch, that's a lot of money for Mary now. And I get it. And most people don't want to do that. But what I challenge Mary is, you got to look at taxes from a macro point of view, not looking at it from a micro point of view. If you look at it from a micro point of view, you're just looking at the tax dollar amount now, and you feel like that's too much, you don't want to do it. We want to challenge Mary, just like our clients, for them to look at taxes from a macro point of view, meaning that, yes, are you paying taxes now? Is that painful? Yes. But we want you to look at it more like over your lifetime, the tax that you're going to save, right? So when we look at this, because we are doing this conversion now the next 6 years, Mary, that will make Mary to pay more in Medicare surcharge taxes, right? Absolutely. So if we add these two together, Mary will pay about $350,000. So what we're doing now here is going to cost Mary to pay extra about, $350,000 in taxes now. That might sound a lot. Ouch, I get it. But given the 2, the 3, I think this makes a lot of sense. Mary looked at this and said, this is no-brainer, right? This is no-brainer, because I'd rather pay $350,000. This is what we call this amount here. This is what we call, Mary, that's your required taxes. That's what the politicians are screaming, saying, Mary, that's the tax you owe. That's what you can pay. But if Mary doesn't look at things in a different way, I wanted to hold on to this money just like majority of the people, because they like to see the account balance growing. If she ends up paying this, it's her choice. This is her choice. So the difference between this amount and here is the optional taxes. Optional taxes that Mary is effectively checking to say, I'm willing to pay this to the politicians. And then Mary is saying to us, no, we're not going to do that. So in essence, what we have done over here is, we are able to, if Mary keeps paying this, went this route, just to keep the IRA, she will pay about $1.3 million in extra taxes. But in our way over here, we are able to save Mary over $860,000 in tax. So folks, this $860,000 over here, we don't just look at this as a number. We just don't look at this as like how much Mary saved. We're talking to Mary to say, Mary, this is the potential amount of money that you can make to build a generational wealth for your family. Think about that for a second. Just because the fact that Mary came to our office, we're able to potentially save Mary over $860,000 that we can put aside, that Mary can create generational wealth for many, many years to come. And that's the power of planning. I did this video on a webinar, and then it went bananas, right? People are calling, Mamadou, I need this information here. That's why we wanted to basically put this into this channel. That way people can see. So if you're a federal government employee and you're watching this video and you get some value in here, the first thing that I'll ask you to go ahead and then subscribe to our channel, because this is where we put very timely information. That way you can get those information and be able to make a profound difference in your life. And I also want you to come and visit us on the channel, because this is where we put videos in here. That way you can keep up with the information that's out there. So the other thing that I would probably also tell you, that if you see value in here, call our office. Pick up the phone and call our office and schedule an appointment for that complimentary your IRA or TSP analysis. That way we can be able to look at how we can help you to potentially save thousands and thousands of dollars in your pocket. That way you too can create a generational wealth. Until then, see you next time, and thanks for watching.